The U.S. economy in 2025, a slow-motion crisis unfolding. How trade wars, debt, and market volatility are creating recessionary conditions. The first 60 days of President Donald Trump's second administration have been marked by aggressive trade policies, rising corporate bankruptcies, market volatility, and financial instability. The collapse of businesses like Jo-Ann Fabrics and Hooters, combined with tariff retaliation, has exacerbated an already fragile economic landscape. Looking at the state of floating rate loans, collateralized loan obligations, and corporate debt, we see alarming parallels to pre-recession conditions. Floating rate loans, often leveraged loans, have been a critical element in corporate financing over the last decade. They fluctuate with interest rates, making them particularly dangerous in a rising rate environment. High borrowing costs. With the Federal Reserve keeping interest rates elevated at 4.5%, companies that took on excessive debt at low rates in the 2010s are now struggling to service their obligations. Increased default risks. Default rates on leveraged loans have hit their highest level in 4 years, signaling a brewing credit crisis. CLO market concerns. CLOs, bundled collections of corporate loans, have been growing rapidly, reaching over $1.3 trillion in value. This market is showing signs of stress, similar to how CDOs signaled distress in 2007 before the Great Recession. The bankruptcy of profitable businesses like Jo-Ann Fabrics and Hooters is a warning sign that goes beyond just poor business management. Instead, it reflects a deeper problem with the structure of corporate finance and private equity involvement. Why are profitable businesses failing? 1. Private equity debt loads. Many of these businesses were taken over by private equity firms that loaded them with debt. Private equity firms use leveraged buyouts to acquire companies, forcing them to take on massive debt while extracting profits for themselves. 2. Rising interest rates. With interest rates climbing, many companies cannot refinance their debt at affordable rates, leading to forced closures and layoffs. 3. Changing consumer behavior. With inflation reducing disposable income, restaurants and retail businesses are among the first to suffer as people cut back on non-essential spending. Example: Jo-Ann Fabrics had a loyal customer base and steady sales. However, it was owned by private equity firm Leonard Green and Partners, which saddled the company with debt, making it unsustainable once borrowing costs rose. Example: Hooters still had profitable locations, but shrinking casual dining traffic, higher rent costs, and burdensome debt loads led to location shutdowns. The rising number of bankruptcies is just the beginning. The combination of floating rate debt, CLO exposure, and tightening credit conditions is eerily similar to 2007. If corporate defaults continue to rise, CLOs could begin unraveling, leading to a liquidity crunch across financial markets. Junk bonds and corporate debt. Stress lower-rated companies that issued junk bonds in the last decade are now seeing spreads widen, making it harder for them to borrow. CLO instability. If default rates continue rising, CLOs, just like CDOs in 2008, could become a systemic risk to banks and institutional investors. Tighter lending standards. Banks and private lenders are already pulling back on high-risk loans, which could create a liquidity crunch for businesses reliant on debt financing. Trade policy has been one of the biggest contributors to economic uncertainty in the first 60 days of Trump's second term. New tariffs on Mexico, Canada, and China. Trump enacted a 25% tariff on Mexican and Canadian imports and a 10% tariff on Chinese goods. While intended to protect U.S. industries, the move has backfired as trading partners retaliate. Supply chain disruptions. Businesses are struggling to adjust as supply chains become costlier and less predictable. Consumer price increases. Tariffs act like a hidden tax, raising the prices of goods and reducing consumer spending power. Stock market volatility. The S&P 500 has entered correction territory, signaling concerns among investors about economic policy direction. closures. While 2024 was a strong year for stocks and crypto, 2025 is proving to be a different story. The S&P 500 has seen a pullback, erasing much of the post-pandemic gains. Volatility is increasing as traders react to uncertain fiscal and trade policies. Bitcoin soared past $100,000 in early 2025, but has since corrected to $84,000, with investors cautious about regulatory crackdowns. Investors are seeking safer assets with increased inflows into gold, treasury bonds, and commodities. Scenario 1. A controlled slowdown. The Federal Reserve adjusts interest rates to prevent a deeper crisis. Businesses adapt to trade policies and inflation remains under control. Markets stabilize, avoiding a deep recession but suffering moderate economic contraction. Scenario 2. A full-blown recession. More corporate bankruptcies as debt costs become unbearable. Trade war escalations lead to higher consumer prices and lower economic growth. CLO and corporate debt failures trigger a liquidity crisis, forcing banks to tighten lending further. Current indicators suggest we are closer to Scenario 2. The combination of high corporate debt, rising bankruptcies, trade war disruptions, and financial market instability is signaling the early stages of a major economic downturn. If default rates spike and trade wars escalate, the likelihood of a deep recession increases significantly. The first 60 days of Trump's second administration have amplified financial instability through aggressive tariffs, corporate debt crises, and rising bankruptcies. While the full impact is still unfolding, key recessionary warning signs are flashing red: leveraged corporate debt and CLO risks, bankruptcies of profitable businesses due to debt burdens, stock market uncertainty, and declining investor confidence, rising consumer costs due to trade wars and a slowing economy with tightening credit conditions. If these trends continue unchecked, the U.S. may enter a full-blown recession by late 2025. Whether policymakers adjust their approach or double down on high-risk strategies will determine how severe the downturn will be.